In this final lecture, we're going to talk about contingencies and ratios. So first of all, contingencies. So how does a company report liabilities when there is uncertainty or ambiguity surrounding the liability? First of all, there could be gain contingencies, sort of as just a side note here, which means there's some sort of gain that they may or may not realize. Those gains under US GAAP can be reported in the notes, but they are not reported on the balance sheet. That's really not the focus here. Our focus is on how to deal with losses. And so loss contingencies may be reported on the balance sheet under the following conditions. So a loss contingency would be something where the firm may have a future economic sacrifice, but either the amount or the timing may not be certain. And so how do you deal with it when there's some uncertainty? First of all, the loss must be at least probable. And so that's sort of that first standard. And second of all, the amount of the loss must be reasonably estimable. So they have to be able to estimate the sacrifice that they're going to have to make. And then finally, if it's neither probable and reasonably estimable, then the contingent loss may be discussed in the notes, or sometimes they don't have to be discussed at all, especially if the loss, the probability of the loss is remote. And so when we talk about probability, there are really three things, three levels of probability, if you want to think of it that way. So there are those that are liabilities or probabilities, that's things that are probable, reasonably possible, and remote. And so probable means that the event or events are likely to occur. Reasonably possible means that the event or events are more than remote, but less than likely. And then finally, remote means that the chance that it's going to occur is slight. And so again, this is the different classifications, and if it's both probable and estimable, then the company must disclose that loss contingency as a liability on their balance sheet. And of course, along with that, there would be a loss on the income statement. So next, we're going to talk about ratios. We're going to just talk about two of them that deal with current liabilities. The first ratio is the current ratio, which is current assets over current liabilities. And so the current assets include the four items in this particular balance sheet highlighted on the left-hand side. And so cash, short-term investments, receivables, and inventory. Of course, there are other current assets, but for this particular company, those are the only four. And so we add those up and we get $263,000. In the numerator or denominator, we can see that there are three current liabilities: accounts payable, unearned revenue, and short-term notes payable. We add them up and we get a denominator of $88,500, which means that the current ratio is 2.97. As far as whether that's a good ratio or bad ratio, it's really hard to say. It depends on the history of the company, the industry, larger macro trends, things like that. It's really tough to say definitively that a ratio of 2.97 is good or bad. The only thing we can say is that as that ratio gets larger, the firm has greater liquidity. And so the current ratio is a measure of liquidity. And so the higher the ratio, the more liquid the firm is. The second ratio is called the quick ratio. And the quick ratio includes a subset of all current assets. And so it's focused only on cash, short-term investments, and receivables. And so inventory, prepaid items, or other current assets would not be included in the quick ratio, even though they're included in the current ratio. The denominator, however, is the same. Same $88,500. And so when we calculate the quick ratio, we can see the quick ratio is 2.32, and of course we notice right away, hopefully, that this is less than the current ratio, and that will always be the case. And so the quick ratio will always be less than or equal to the current ratio. In this case, 2.32 compared to 2.97. Again, it's difficult to say whether it's good or bad. The only thing we can say is that higher levels of the quick ratio means that the company is more liquid, even with a more stringent measure of liquidity.